Today's podcast is a continuation of the masterclass that I did earlier on Spotify on wills and foundations. Since then, we've had many more requests for setting up our foundations, and we've had many more queries concerning the tax aspects of foundations, because many of our UAE clients here are putting a lot of their real estate portfolios, shares in their UAE companies, etc. into the foundations. So today, let's not hear it from me, let's hear it from the expert. My guest today is Amit Thaper, Partner, Corporate and International Tax, who is a member of the Institute of Chartered Accountants of India and qualified in 2007. He has a lot of experience with 4 different accounting firms over a period of 14 years, and obviously has a significant more experience in tax matters than I do, where he advises multinationals, startups, overseas investors in technology, telecom, manufacturing, defense, and oil and gas. He has also advised corporations on tax implications of business transactions. As you know, there are issues around transfer pricing, permanent establishment, royalty, other kinds of structuring, etc. So we are also going to take some information and from his experience on advising in India, which is a vastly advanced tax regime in terms of a lot of the things that we have, where he has also done cases before the Income Tax Tribunal and the High Court as part of his experience. So I would very much like to welcome Amit to our podcast today. And let's break down foundations. What are the tax liabilities around foundations? What does it mean to have one? What do you need to do if you are a founder and wish to have a foundation for yourself or your family business? Is it the right structure for you? And potentially, what are the implications of having one? So let's hear it from Amit, my questions to him. Once again, thank you so much for watching us and for hearing us and being with us on Spotify. So today we have Amit here with us. Amit is a guru in tax. And the reason we thought we would do this podcast is to build on our masterclass that we did on wills and foundations, because we have had so many queries in the UAE about wills that have now been allowed for expats. And there's many different types of wills you can do. And also foundations, which is still a fashion, despite a lot of family businesses having lots of corporate structures and things like that. So let's hear from Amit a little bit about him before we launch into my usual amazing questions. Amit, can you tell me a little bit about yourself and your background?
Thank you, Jayshree. Hi, everyone. My name is Amit. I'm a tax professional. I've been associated with MHA in UAE for last 3 years. I'm a chartered accountant by qualification and always been a tax professional for the last about 20 years now.
Wow, that's a lot of tax time.
Yeah, I always enjoyed it. People consider it boring, but I like it.
I think people don't consider it boring. I think people are just scared of it.
Yeah.
Because there's so many nuances and so many sub-clauses to every, law that relates to tax, and that's what's scary,
Absolutely. Since I come from India and Indian tax laws are complex.
Yeah.
In UAE, it's a bit of a relief because UAE corporate tax law is not that complex.
As yet.
As yet,
only one year
with a lot of regulations that keep coming on. And generally speaking, tax laws, whatever may be the intention of the regulators and the government, they end up being complex.
Right.
So we just keep our fingers crossed here.
So in terms of the Indian tax law and the UAE, what kind of parallels would you draw?
The basic rules of taxation remain the same. And since there is no personal taxation in UAE, while there is personal taxation in India, so that's completely different.
Right.
But as far as the corporate taxation goes, there are a lot of similarities as well, because taxes are applicable on business income. All your expenses are eligible for deduction. There are certain restrictions here as well as in India on eligibility of tax deductible expenditure. So those are the similarities.
Right.
There used to be a lot of tax incentives in India, but they have been gradually phased out. But here we see a free zone regime, which allows for a 0% corporate tax rate. So that is also an incentive which continues here, because we are still in the very early years of taxation in the UAE. But as we see the manner of calculation of taxes, what will be taxable, what will be exempt, there are quite a few similarities.
So you talked about free zones, which is a really great segue into this conversation. So free zones generally had a 50-year tax exemption in the UAE. Now, with the corporate tax regime coming in, free zones have also been required to file corporate tax. And my understanding is many of them have had to pay corporate tax when it's over the threshold. So when you say exemptions still exist, what exists and how does it really work?
Exemptions still exist. You're right that as per the regulations of these free zones, there were 50 years of tax holidays. That still exists, and to that extent, corporate tax law is aligned with the free zone regulations that allowed for a 50-year tax holiday. But to some extent, it has been diluted because now it's not a blanket tax exemption. It is for certain types of businesses, certain types of business activities. There are checks and balances. Earlier, there were no restrictions or no requirements of mandatory audits. There were no transfer pricing regulations, but now with the introduction of corporate tax law for 0% tax rate exemption of income, you must get your books of accounts audited. There are stringent regulations about transfer pricing, which deals with related party transaction that have to be undertaken at the same pricing as you would charge to an unrelated party. And accounts keeping, bookkeeping requirements are there. As I said, that it's not a blanket exemption. The FTA has listed down around 13 or 14 activities that qualify for a 0% tax exemption. Yes, the tax exemption still prevails, but it has been diluted to some extent.
Right. So, yes, so I think our understanding is correct. And I think what we are seeing as a law firm is that obviously many clients that had BVI, Panama, Mauritius, Singapore structures, but effectively ran their operations out of the UAE, obviously then decided to have their companies in the UAE.
Yeah, that's a big change.
Yeah, exactly. Yes. Which means they brought their families, their businesses, everything here. Like slowly, I could see the transition happening a few years ago, right? Their families were moving here. Their kids were starting to go to school in the UAE because we have great schools here. And then the next thing you know, like they can't really fly in and fly out of like London, Mumbai, Delhi, Netherlands, or whatever the case may be. So they started moving their head office here while their companies remained in all these different jurisdictions. So we have seen a big move towards the DIFC and the ADGM in terms of corporate structures. And one of the things I wanted to brainstorm with you today is also what I call the fashion of foundations. So we've had a lot of clients, especially high net worth individuals and big family businesses, setting up foundations as a way to being not only a wealth structuring tool potentially, but a tool in terms of succession planning because of the variety of instruments you have, like writing up a charter where you can basically say anything. Now, I have mixed views on that, which I've openly expressed in some of my masterclasses and talking about wills and foundations. But talking to you, what is your experience on advising on foundations in the UAE at this point, in this moment in time?
Jayashree, foundations have existed in the UAE for a long time now. UAE has a well-developed and well-regulated framework for foundations, be it ADGM Foundation framework or DIFC or RAC ICC. Especially high net worth families having big real estate portfolios do prefer foundations as an instrument for succession planning, for asset protection, to protect the assets from the personal liabilities, for ensuring that there are no inheritance related issues. So foundations have been preferred not only for asset holding, but also for passing on the assets as well as the businesses.
Well, as long as you transfer the assets to the foundation.
Yes, you have to transfer the assets. So the personal control of the owner gets diluted to that extent because there are governance related issues, there are governance related regulations in each family foundation law. So to that extent, that personal control is lost. But on the other side, if you see, these foundations are very well regulated. So that discipline comes in, regulating the assets, to ensuring professional management of these assets, ensuring that the income that arises from these assets goes to the beneficiaries in a well-defined manner, and to that extent, the disputes gets reduced.
That's a really good take on it. I mean, what are the kinds of clients you've seen? Have you seen big corporates coming to MHA who said, look, we want a foundation. Some of our founders are now in the business, or our shareholders wish to have it. Or do you see that mainly as high net worth family businesses using this as a tool? What's been your experience?
Actually, these are mostly family businesses, but those family businesses are not only restricted to UAE. Yes, there are groups that are purely family-driven groups with lot of real estate holding that have set up the foundations here to manage their property,
Right.
to achieve tax efficiencies, to ensure their returns from their assets are well distributed.
Right.
Not only the UAE-based businesses, but lot of interest has been shown from high net worth business families outside through the concept of family offices.
Right.
So in India, for example, tax laws there's a lot of tax leakage. So business houses are preferring locations like Singapore and Dubai
Right.
for setting up their family offices for their wealth management.
So sorry, can I backtrack? Can you break up what tax leakage means for our audience?
If I look at purely a holding company that is managing and holding real estate assets, by default, it becomes taxable, right? But if you look at foundations, so if a founder or the business owner transfers certain real estate, which is not meant for real estate business, but it is a family property. But at the same time, they want to ensure that the income is not taxed. So foundation allows that to happen. So in foundation, especially if you look at the UAE corporate tax law, there is a tax exemption which is available to the foundations, but that is not automatic.
Right.
So one has to contribute the assets into the foundation, ensure that you do not do it as a business activity, you do not engage in trading of those real estate assets.
Don't start using it as your
don't use it
operating
as a conduit to bypass the tax laws. But if you do it in a proper way, in a structured manner, in compliance with the corporate tax law, get the approval of the FTA, because that is mandatory for ensuring tax pass-through status, as we call it.
So at what stage in a foundation do you need to get FTA approval? So let's say I've set up a foundation. I haven't transferred any assets into it. My goal, as you said, is to transfer my real estate and my shares, say, in my UAE companies, etc. What stage do I get the FTA approval?
Once you set up the foundation, so first thing is you get your charter documents, bylaws and all ready, drafted. You get yourself registered in a foundation framework in DIFC or ADGM, as we have here.
Yes.
Let's say you contributed few real estate assets in the foundation. Now UAE concept of tax year or tax period, which usually most of the cases runs from January to December. So before you close your first year, because once you have contributed the properties, you may be expecting some incomes out of it. So before you close your first taxable period, you have to approach the FTA, make an application for exemption. You have to give certain undertakings. There will be some queries being asked by the FTA. And then comes the stage of, if they agree with your framework and the type of activity you're doing in the foundation, they will give you an exemption, which means that from that very year, you are exempt from corporate tax. The foundation is exempt. Even if you don't do it in the first year, it will be considered as taxable. So it will be like, by default, a foundation is a taxable entity, right? It's the default position.
Yeah, that's good to get it up there.
That's default position. So when I say it's not automatically exempt, it means by default you are treated just like a company. You are liable to pay a 9% corporate tax in the UAE. But once you get the approval, you meet with all the conditions. From that year onwards, you become exempt. So if you get the approval in the first year itself, before you close your first year, you're exempt from the first year. Let's say you didn't do it in the first year, you did it next year, from the next year you'll be exempt.
And could you, off the top of your head, explain to me how I would qualify for exemption? What are those conditions that allow me to continue to be exempt from the corporate tax requirement?
So it has to be, you have to register yourself as a foundation, you have to have your bylaws and charter in place. You need to contribute whatever assets you want to contribute in the foundation. You need to ensure, it's very important, and I can give you an example here also. In one of our clients, everything was all right. It's just that they contributed some real estate into the foundation, assuming that a foundation is by default an exempt entity. But what happened is that there is one important condition for exemption, is that you cannot undertake any business activity through the foundation. Foundation is for very specific purposes. It's not for any business activity. So they were doing buying and selling of real estate. Right. So that resulted in rejection of their application.
Right.
So one has,
which is also a violation of the licensing
violation
rules.
It was DIFC foundation. So DIFC law on foundation also doesn't allow you to do any business activity. So that's a violation of DIFC law as well. But corporate tax looks at it very closely, because it's like leakage of tax revenue from the government. It's 0% versus 9%. The government is foregoing the revenue provided you're doing everything in as per the law. But they look at it very closely, so they rejected because their financial statements were clearly showing that they are doing business activity.
Right. And is that the biggest problem you see?
It's the biggest problem because other things are by default falling into place. You always have a registered foundation. You know,
yes, of course.
You will draft your bylaws. Your beneficiaries are clearly defined. Derive out of foundations clearly defined. But where the things get stuck is to convince the tax authorities that this foundation is not doing any business activity. The objective is not to evade corporate tax, but to manage the family wealth.
Right. So what happens if my rental income from these properties comes into the foundation? Technically, then that's not taxable and my family can enjoy the rental income without any tax liability on the foundation?
Let's try to understand it in two different scenarios. So let's say there is a company or an unapproved foundation. When I say unapproved, I mean it doesn't have the exemption approval from the FTA.
Right.
Foundation is there as per law, but it's not an approved foundation.
So the default position is taxable.
So whatever rentals that are coming in the foundation, or if the foundation has sold any property and there is a gain on that, capital gain on that property, then it's 9% you have to pay as a corporate tax. Now let's take the other scenario. The foundation has approval from the FTA. It derives rental income gets accumulated. So the foundation is considered as tax pass-through. When I say pass-through, the foundation is not taxed in its own right. It is considered as transparent. Beneficiaries are clearly defined in the charter. So let's say there are two beneficiaries and their share is 50-50. So the income that goes to the beneficiaries, so one has to see what is the corporate tax implication in the hands of the beneficiary. So beneficiaries are usually individuals and individuals are not liable to corporate tax. So effectively the entire income, both in the hands of the foundation as well as in the hands of the beneficiaries, goes tax-free.
That's a really great explanation. And in terms of the last few years, have you seen your clients shift from the Singapore, outside of the UAE, like Panama, etc., which we saw quite a lot, Gibraltar, BVI?
Yes.
Have you seen a big shift? Is that something you are seeing, like what the example I gave you before?
I would not say it's a big shift, but gradually it is happening. The businesses are realizing the well-defined framework, well-regulated framework of UAE. If you look at ADGM or DIFC, there are stringent compliance norms to ensure that the foundations are governed properly. They have their own courts to ensure that disputes are settled in a very proper manner. So yes, interest is being shown. Some of the foundations have being set up by shifting their base from Singapore, especially the family offices I'm talking about.
Yes.
Because in family offices, generally the structures that are followed is a foundation at the top and there are multiple layers underneath it. And the unique thing about the UAE corporate tax law is that once the foundation obtains tax exemption, there is possibility of entities beneath the foundation are also exempt. Again, you have to apply for the exemption. So entire chain can achieve tax neutrality in here.
So can you contrast that with trusts? Now, the reason I ask this is because we also have clients who are married to Americans, citizens, for example, or have I have a client who moved here many years ago. He has a significant business in India, but he's a British national, has significant real estate interests around the world. So he decided to base himself out of Dubai. At that time, he got really great advice from Europe and ended up setting up a huge number of trusts. I never understood the structure. I had to unravel it a little bit. But can you perhaps help us contrast foundations with trusts and from your kind of like your deep tax knowledge as well, like, both the nuances?
See, trust is basically an agreement driven. It's a relationship between the settler and the beneficiaries. The trust can also have this tax transparency. It can also be deemed as a family foundation if it meets all the requirements. But if you see, the foundation structure is more a corporate-like structure.
More robust.
More robust structure. It's more acceptable in terms of when you have to employ certain professionals to manage the property of the foundation. So far, we have not seen that. Trust is more like a very private thing, right? But foundation is more corporate driven. It gives more credibility to the entire structure. And the most important thing is when we look at the trust structure, it's mostly between individuals. Here in the foundation, we can set up multiple SPVs as well. So that gives you more flexibility. Suppose there are operating businesses, there are residential properties, commercial properties. You can house them in separate SPVs beneath the foundation. So that entire wealth management structure can be created through the foundation.
Yeah, you make it sound very neat and tidy. So maybe I need to change my mindset about the structure myself. Everything sounds like it could work, but where do you see things can go wrong in practice? Or what are the problems you foreseen in structures like this? Whether it's from your UAE experience or Indian experience.
The problem, I would not say a problem, but it's more like a challenge that sometimes we have seen the founders or the promoters are not willing to let go of the control. In the foundation, you have to follow the governance framework, which is as per the bylaws, right?
Yeah. Which usually the founders have all set themselves, you know?
They have set themselves, but there are council members. So you have to have multiple people giving you advice, and their inputs are also as per the framework which is agreed between the founder and the council members. So that direct control over the property somewhere is diluted. Secondly, foundations sometimes can be costly because it's not a one-time expense to set up a foundation. You have to ensure the foundation laws, regulations are followed. There are bookkeeping requirements.
Annually, like any company.
Annually, there are tax filings.
Yeah, sure.
If a family is managing the property on its own or there is a trust, those expenses are not there, but it's ongoing. It's not one-time cost, it's an ongoing cost. So that is another thing which we have seen. And as I mentioned in the beginning of our discussion, that some of the families have set up the foundation assuming that it's in a free zone like DIFC or ADGM, it's a foundation, so it's exempt. Unexpectedly, they are facing tax consequences. Yes.
That's actually the biggest misconception we've seen.
Yes.
Where they set it up with the view that it was going to be hunky-dory and they didn't need to do it.
They don't have to do anything, no filing, but even, there are regulatory filings, right? You have to, it's not only tax filings, there are annual filings requirement in DIFC and ADGM as well. So compliance cost gets created.
Of course, which we're seeing throughout. I mean, the fact that now we have a corporate tax regime, every business, no matter how small, needs to obviously have its ducks in a row, and it always should have, but obviously tax laws push these things a bit more forward. Have you seen any banking challenges around foundations?
Banking challenges we have not seen, because if a foundation is in a well-regulated jurisdiction like ADGM and DIFC, they are compliant with the norms. They have their own KYC, AML norms. Their charter documents are there. So that's what I was trying to distinguish. When you have a trust structure, it's slightly more informal. But foundation is a more formal structure. So its acceptability with banks is also higher. So we have not really faced any challenges with banks so far.
So that's really good. That's really good news for everybody who set up the foundation. So as long as you don't end up in a governance friction, you don't end up in a situation where you haven't transferred any assets to the foundation, which means it can't work for you. And as long as you ensure that everyone's in the loop, you have good governance, you're taking everybody on board as per the bylaws, and you're complying with all the rules and regulations, this could potentially be an excellent way to structure your...
Absolutely.
Right.
See, the family or the business house that intends to set up a foundation has to have very clear objectives. One of the objectives is that it has to be for long term. It cannot be transactional. So once you have transferred the properties, you must have a very clearly defined objectives why you're doing it. It's not only the real estate portfolio, it may be shares of the operating companies below the foundation structure to ensure that the income and the assets remain within the family and they pass on generation from generation. But if there are very few assets, right, and there are no complexities associated with the family as regards, there are no disputes, there are no sharing of income issues within the family, then probably a simpler structure like a well or a trust may be suitable. So foundations are for slightly more complex portfolios, more complex families with inheritance issues. That's where foundation can be helpful more than a trust.
Sure. Yes, we've seen that in our experience as well. We found that sometimes when we have a nuclear family that's looking to set up a foundation, it's not per se as effective because sometimes even the children are not in the family business or they're minors, they're still studying, but the father's taken a step forward and decided to set everything up in a foundation. But per se, it hasn't turned out to be as valuable because he's the only one in it making decisions.
Yeah, it may not be required in that case. You can very well do it with a well-drafted will also.
Yes, yes. And we've seen that as well. Now we have the ADJD wills, which potentially Muslims can have in the Abu Dhabi court. So we are seeing a big trend in that. DIFC has always been the case where we've had a lot of probates as well on the wills. So we know it works. Unfortunately, we've had clients who passed away and we've had to enforce their will. And then obviously you have the ADGM option as well. So
absolutely,
we've definitely seen that. So I think what you're saying is like you kind of one size doesn't fit all.
Absolutely.
We need to see the combination of wills, foundation, potentially other structures you may have around the world. I think for us, I think our biggest challenge sometimes can be when we get thrown Malaysian structures, Indonesian structures, Australian structures, British or English companies at us. And then we're asked to like figure out what's required in the UAE.
No, that becomes very difficult. And you touched a very valid point that it's not restricted only to a foundation. A family can very well have some assets in the foundation, but it can leave aside some assets which can be, distributed through a will also.
Right.
Foundation is when you have large complex family with a lot of family members, there is a potential for heirship issues. There is a large portfolio of assets and companies to be managed, and you need professional management for that, which can be outside of the family.
Right.
Then there is more of a case for a foundation.
There's more value.
More value.
Yeah. I'm always for value-driven structures rather than doing it because everyone else.
You cannot do it just because everyone else is doing it, just because there is a fancy. There is some sort of,
Yes, I know. It's fashionable.
It's fashionable. Everybody's doing it.
Yeah.
It looks good to have a foundation. It looks jazzy. So it's not that you have to have very clearly defined object.
That's great insight. But if you had one piece of advice to give somebody who walks into MHA's office and say, I want a foundation, what's the advice you give them? What's the one piece that you tell them?
First of all, I would like to ask them why do they need a foundation. It's not that, okay, I can get the foundation set up, I can charge a good fee for that, but it's not right to advise before understanding why they want to set up a foundation. If there is a case for a foundation, like there is a big real estate portfolio, there are a lot of operating businesses, there is a large family members,
right,
and they foresee succession disputes, all these factors will come in handy before we zero in on a right structure. It can be a situation where, okay, it's a non-complex matter. We can set up a foundation, that is fine. But where there are operating businesses also, I might advise them that, okay, foundation as a top entity, as a holding or centralized control through a foundation is good. But for operating businesses, you need to have multiple SPVs because you cannot have those businesses in the foundation. So, the structure has to be created depending upon the needs of the individual.
Right. The one question that we do get is, so, Jayashree, I've set up my foundation. Am I done?
Setting up the foundation is an easier part. But while setting up the foundation, one has to be very mindful of what bylaws we are drafting, what the charter says. Because many times what happens is that, just as you said, that if a founder comes and I have set up the foundation, everything is fine. One of the objectives of setting up the foundation is to ensure that there are no disputes as regards distribution of income from those assets and succession is sorted. But it's not like once you have done, it's okay. It has to be done correctly to avoid any future disputes. So everyone has to come on the table, ensure that your governance structure, your council, your powers are well defined in the founding documentation, so that future issues between the family members are avoided. One good part about the foundation is that once the assets are transferred in a foundation, they are immune from the personal liabilities of the founder. They are in a way ring-fenced in the foundation.
Yes, that's a fabulous benefit from an insolvency and bankruptcy perspective.
Yes, but one has to see that at the beginning itself, it is not done with the intention of defrauding anyone.
Of course.
Because then things can go wrong, and it may not be the way you intended to be.
Right.
So your intention, your objectives have to be very clearly defined. You must be very clear in your mind, and that has to come on the documents that you have created for the foundation.
Right. No, I like that. I like when I see a charter of a foundation which is extremely detailed and has very specific rights and rules and obligations,
Yes.
and duties of the parties involved in the structure.
Absolutely.
So yeah, that's a good insight. But I mean, I guess we can't guarantee that the family won't fall out with each other after the foundation has been set
that
up.
nobody can say. I mean, the biggest of corporations we have seen collapse. Once they were very profitable and they've set an example, but due to some governance issues, we have seen big corporations go down. So, anything can happen with the foundation also. But when a foundation is set up with the right intent, following the right processes, and the governance framework is correct, then that's a great tool to ensure that your succession planning is sorted, your wealth is protected from the personal liabilities of the founder.
Yes, and reduce the nature of disputes arising, because there's everything to gain for everybody in the foundation structure.
It's more like to reduce the possibility. It cannot be eliminated. It's not a foolproof thing to eliminate future disputes. But if done properly, if documentation is drafted properly, then yes, these disputes can be reduced.
Thank you very much for your insights. That's been very valuable. Thank you.
Thank you.